While most crypto investors are frantically checking Bitcoin charts and chasing the latest meme coin, something fundamentally different is happening in plain sight. We're in February 2026, and the financial infrastructure of the global economy is being quietly rebuilt on technology that most retail investors still don't understand. This isn't about speculation. This isn't about getting rich quick. This is about recognizing that the boring, unsexy work of enterprise blockchain adoption has reached a critical inflection point, and one network has positioned itself at the absolute center of this transformation. Hedera is currently trading around 0.09, down roughly 47% over the past 3 months, and 82% below its all-time high of 0.57 from September 2021. The technical picture looks brutal. Price sits below all major moving averages, with the 20-day EMA at 0.10, the 50-day at 0.11, and the 200-day at 0.18. The RSI hovers around 36, approaching oversold territory but not quite there yet. The MACD remains in negative territory, indicating bearish momentum hasn't fully reversed. Bollinger Bands show HBAR trading near the lower band, typically a sign of oversold conditions, but in this market environment, it could just as easily mean more downside is coming. The Fear and Greed Index for crypto overall sits at 6, indicating extreme fear across the entire market. For traders focused purely on price action, this looks like a disaster, and in the short term, they're not wrong. Support at 0.09 is being tested, and if it breaks, the next level is 0.8 with potential to drop as low as 0.075 if broader crypto weakness continues. The chart is screaming danger, and anyone telling you HBAR is about to moon tomorrow is either lying or delusional. But here's where it gets interesting. While price is getting crushed along with every other altcoin in this risk-off environment, the fundamental adoption metrics for Hedera tell a completely different story. And that divergence between technicals and fundamentals is exactly what creates generational buying opportunities for those willing to look beyond the next candle. Let's talk about what actually happened in 2025 while everyone was distracted by price. Hedera processed over 10 billion in real-world asset settlements on its network. Not hypothetical use cases, not proof of concepts that might happen someday. Actual institutional money moving through the system for legitimate business purposes. To put that in perspective, most blockchains celebrate when they hit a few million in transaction volume from actual utility rather than speculation and wash trading. Hedera did $10 billion, and that number is verifiable on-chain, not marketing hype. Red Swan CRE has tokenized over $5 billion in commercial real estate on Hedera, transforming illiquid buildings into digital assets that can be traded with the efficiency of stocks. StakeX began tokenizing over $100 million in institutional real estate using jurisdiction-aware standards that embed KYC, AML, and lifecycle logic directly into the tokens themselves. In the United Kingdom, Lloyds Banking Group in Aberdeen completed the country's first foreign exchange trade using tokenized real-world assets on Hedera as collateral. This wasn't a test. This was a live production trade where smart contracts handled multi-party settlement, collateral verification, and regulatory reporting simultaneously. That level of complexity requires infrastructure that can handle enterprise-grade workloads with guaranteed finality, predictable costs, and regulatory compliance built into the architecture. Australia launched the AUDD, the Australian Digital Dollar, as the country's first native stablecoin built using Hedera's Stablecoin Studio. This represents institutional-grade fiat on-ramping for Asia-Pacific markets, creating a corridor between traditional banking infrastructure and public crypto rails without the friction that makes most crypto-to-fiat experiences painful for users. Georgia's Ministry of Justice announced plans to migrate its national real estate registry to Hedera's network, following Dubai's tokenization initiatives that have positioned Middle Eastern governments as early adopters of blockchain infrastructure for sovereign use cases. When governments trust a network enough to put national property records on it, that's a different tier of validation than a speculative trader buying tokens, hoping number goes up. The Bank of Ghana is running CBDC pilots on Hedera. Shinhan Bank and Standard Bank are leveraging the network for cross-border remittances. These aren't announcements of partnerships that might lead to something eventually. These are live deployments with named institutions moving real money through the system today. The technology that makes this possible is fundamentally different from traditional blockchain, and understanding this distinction is critical to understanding why enterprises choose Hedera. Most blockchains use a sequential chain of blocks where transactions are processed one after another, creating inherent bottlenecks as transaction volume scales. Bitcoin processes roughly 7 transactions per second. Ethereum, after all its upgrades processes, maybe 15 to 30, depending on network conditions. Hedera uses hashgraph consensus, which is a completely different architecture built on a directed acyclic graph where transactions can be processed in parallel rather than sequentially. The result is throughput capacity between 10,000 and 30,000 transactions per second per shard, with sharding protocols now fully operational in 2026, creating what's effectively infinite horizontal scalability. Transaction finality on Hedera happens in approximately 2.9 seconds, meaning once a transaction is confirmed, it's irreversible and final. For enterprises moving millions of dollars in tokenized assets, that certainty matters enormously. You can't have a situation where a $50 million real estate transfer might get reversed 30 minutes later because of a chain reorganization or network fork. The energy consumption per transaction is 0.00017 kilowatt hours, making Hedera one of the most energy efficient networks in existence. Compare that to Ethereum's post-merge consumption of 0.0026 to 0.01 terawatt hours annually, or Solana's 0.166 watt hours per transaction. And you start to understand why institutions concerned about ESG compliance and carbon footprint gravitate toward Hedera. The governance structure is equally important and equally misunderstood. Hedera is governed by the Hedera Council, which as of 2026 includes 24 major global enterprises. We're talking about Google, IBM, Boeing, Dell, LG Electronics, Nomura, Deutsche Telekom, and other Fortune 500 companies that don't just run nodes, but provide corporate governance, ensuring the network remains fair, fast, and compliant with rigorous legal frameworks. This isn't anonymous developers controlling the network from undisclosed locations. This is named corporations with reputations and legal accountability. When you're a bank or government considering where to build critical infrastructure, that governance model provides assurance that traditional crypto projects simply cannot offer. In May 2025, Hedera completed a governance rebrand, transitioning the HBAR Foundation to the Hedera Foundation and renaming the Governing Council to simply the Hedera Council to clarify roles and responsibilities. Charles Adkins became CEO of the Hedera Foundation, while Tom Sylvester took over as president of the Hedera Council. The foundation focuses on expanding the ecosystem and developer adoption, while the council oversees protocol governance and validator policies. This separation of concerns created structural clarity that appeals to enterprises evaluating long-term infrastructure decisions. The launch of HashSphere in March 2025 represented another major development that most retail investors completely missed. HashSphere is a hybrid network platform that allows enterprises to deploy private permissioned networks that connect seamlessly to Hedera's public network and other EVM-compatible ecosystems. This solves the fundamental tension that has prevented enterprise blockchain adoption for years. Enterprises want the transparency, immutability, and efficiency of public blockchain, but they also need transaction privacy, regulatory compliance, and control over who can access sensitive business data. Most blockchain solutions force you to choose one or the other. HashSphere gives you both. You can run private transactions through a permissioned network for internal business processes while anchoring critical data points to Hedera's public mainnet for transparency and auditability when needed. That flexibility is what finally unlocks enterprise adoption at scale, and 2025 data shows it's working. Hedera's network processed over 1 billion transactions monthly in 2025, and the vast majority of that volume came from actual utility rather than speculation. The integration with artificial intelligence infrastructure is another development flying completely under the radar. NVIDIA is utilizing Hedera for verifiable compute within their Blackwell AI chips, ensuring that AI-driven data is tamper-proof and traceable from the point of origin. In a world where AI hallucinations, data poisoning, and model manipulation are growing concerns, having an immutable record of AI training data and decision logic becomes critically important for regulated industries. Google has integrated BigQuery with the Hedera network, allowing institutions to analyze massive data sets with the transparency and auditability of a decentralized ledger. Intel is focusing on AI governance hardware that connects to Hedera for compliance and attestation purposes. Prove AI, a solution built exclusively on Hedera, enables enterprises to scale AI technologies responsibly while maintaining control over training data and ensuring automated compliance with global standards like the EU AI Act and NIST frameworks. The carbon credit and sustainability use cases are similarly substantial. Hyundai Motor Group uses Hedera for immutable carbon emissions tracking across their supply chain. B4 eCarbon provides high-integrity emissions reporting using Hedera's HashSphere technology. Repsol leverages decentralized digital identity on Hedera for secure business interactions and ESG verification. In a world increasingly focused on corporate sustainability and carbon accountability, having a trusted, immutable ledger for environmental claims becomes table stakes for major corporations, and Hedera has positioned itself as the infrastructure layer for that verification. Now let's address the elephant in the room. If all of this adoption is real and substantial, why is the price getting destroyed? The answer is actually quite simple and has nothing to do with Hedera's fundamentals. The entire crypto market is in a severe risk-off environment driven by macroeconomic conditions that I covered in detail earlier. Unemployment is rising, consumer debt is at record highs, institutional capital is flowing out of crypto ETFs across the board, and retail investors don't have spare capital to invest in speculative assets when they're worried about keeping their jobs. Bitcoin is down 40% from its October peak. Ethereum is getting crushed. Solana is bleeding. Every single altcoin, regardless of fundamentals, is suffering because crypto assets trade as high beta risk assets correlated to technology stocks and broader risk sentiment. HBAR's correlation to Bitcoin and broader crypto markets means that when everything sells off, HBAR sells off too, regardless of what's happening with enterprise adoption and network usage. This is frustrating for long-term holders who understand the fundamental value being built, but it's also completely normal and historically has created the best entry points. In 2018 and 2019, Ethereum traded below $100 while the foundation for DeFi was being built. In 2020, Solana traded below $2 while the infrastructure for high-frequency decentralized applications was being deployed. In both cases, price lagged fundamentals by 12 to 24 months before explosive moves higher when market conditions improved and retail attention returned. The February 2026 entry into the Digital Monetary Institute represents Hedera's formal seat at the table with central banks, financial institutions, and global payment providers in shaping policy around central bank digital currencies and programmable money. This isn't a marketing partnership. This is direct involvement in the regulatory and technical frameworks that will govern how money works in the digital economy. From the Bank of Ghana to the Reserve Bank of Australia to Project Acacia cross-border payment initiatives, the blueprints for national digital currencies are being influenced by and in many cases built directly on Hedera's infrastructure. When the world moves towards CBDCs, which appears increasingly inevitable regardless of how anyone feels about it politically, the question becomes which networks will power that infrastructure and benefit from that transaction flow. The launch of the first US spot HBAR ETF with ticker HBR provides a regulated investment vehicle for institutional capital, though flows have been modest so far at approximately $1.46 million in recent weekly inflows according to latest data. That's tiny compared to billions flowing through Bitcoin ETFs, but it's also brand new and represents the beginning of what could become substantial institutional allocation as regulatory clarity improves. Canary Capital officially increased its HBAR ETF exposure to 532.7 million tokens as of February 9, 2026, representing roughly 1% of Hedera's total 50 billion token supply locked within a single institutional vehicle. When a major fund secures 1% of an asset's total supply, they're not looking for a quick trade. They're building a strategic position based on long-term conviction. Perhaps more significant, Vanguard has begun offering HBAR exposure to their 50 million clients through ETF products, placing the buy button directly in front of some of the world's most stable and long-term capital. Vanguard clients aren't day traders, they're retirement savers, pension funds, and endowments with multi-decade time horizons. That demographic entering the HBAR market represents a fundamental shift from speculative retail to institutional accumulation. Data on ETF flows shows 5 consecutive months of steady inflows from October 2025 through February 2026 with 0 significant outflows. Cumulative assets across funds like Grayscale, VanEck, Osprey, and Canary now surpass $92 million in year 1. That might sound small compared to multi-billion-dollar Bitcoin ETFs, but for context, total crypto ETF inflows have collapsed across the board. Bitcoin ETFs saw $4.57 billion in outflows in November and December 2025 alone. The fact that HBAR ETFs are seeing consistent inflows while everything else bleeds is actually remarkable and suggests institutional conviction independent of short-term price action. The CEO of Canary Capital noted in recent commentary that institutions are maturing beyond early open-source blockchain experiments. While some believe giants like JP Morgan would simply use Ethereum, the reality is they often prefer networks that offer predictable costs, guaranteed finality, and institutional-grade governance. This is why rotation is happening toward assets like XRP for payments, Hedera for enterprise infrastructure, and Solana for high-frequency applications. Each network is finding its lane based on actual strengths rather than marketing narratives. For Hedera, that lane is clearly enterprise and government infrastructure where reliability, compliance, and energy efficiency matter more than hype cycles and social media engagement. Looking at tokenomics and supply dynamics, HBAR has a maximum total supply of 50 billion tokens, with approximately 38.25 billion currently in circulation, representing 76.5% of total supply. The vesting schedule shows most team and early investor allocations fully vested by 2025, meaning future token inflation is much more predictable and comes primarily from treasury releases for ecosystem development. This makes the supply dynamics healthier going forward with reduced selling pressure from insiders. The network uses a proof-of-stake model where HBAR tokens are staked to help secure the network and process transactions. Transaction fees are paid in HBAR, creating constant demand as network usage increases. Unlike speculative networks where tokens have questionable utility, every enterprise deployment on Hedera requires HBAR to function, creating direct correlation between adoption and token demand. The risk factors need to be acknowledged honestly. Technical structure remains bearish, with price trapped in a descending channel that's been in place since mid-2024. A break below 0.U85 would target 0.075 and potentially invalidate near-term recovery scenarios. The broader crypto market remains in extreme fear mode with no clear catalyst for reversal in the immediate term. Regulatory uncertainty persists despite improvements, and the pace at which enterprise pilots convert to full production deployments will determine whether transaction volume can create enough organic demand to support higher valuations. There's also the risk that enterprises use prepaid accounts or private implementations that don't require purchasing HBAR on open markets, which would mean network usage doesn't translate directly to token price appreciation. Competition from other enterprise-focused networks like Ripple's XRP for payments, Stellar for remittances, and emerging Layer 2 solutions on Ethereum means Hedera doesn't operate in a vacuum. Market conditions could remain challenging throughout 2026 if recession fears materialize and institutional risk appetite stays suppressed. The correlation to Bitcoin means HBAR could drop another 30% to 50% if Bitcoin retests $40,000 to $50,000 levels, regardless of Hedera-specific developments. None of these risks should be dismissed, and position sizing must account for worst-case scenarios. However, the bull case is equally compelling for those with multi-year time horizons. Analyst forecasts for year-end 2026 range from $0.18 on the conservative end to $0.50 on the optimistic end, with median projections around 0.35. Those targets assume ETF approvals continue expanding access, sovereign use cases move from pilots to production, real-world asset tokenization scales from $10 billion to $15 billion or $20 billion annually, and Bitcoin recovers to $110,000 to $130,000, creating a more favorable risk environment for altcoins. If even the conservative scenarios play out, that represents 100% to 200% upside from current levels around 0.09. The bullish scenarios that assume multiple ETF approvals, major CBDC deployments going live, and sustained developer activity translating to meaningful dApp volume reach 0.60 to 0.80 by late 2026. Historical price patterns show February has been a statistically bullish month for HBAR, with average gains of roughly 38% dating back multiple years, potentially attributed to post-holiday portfolio rebalancing and renewed risk appetite early in calendar years. While past performance obviously doesn't guarantee future results, seasonal patterns occur with enough frequency to be statistically relevant. The current technical setup near oversold levels, combined with extreme fear sentiment and institutional accumulation happening below market awareness, creates conditions similar to late 2018 and early 2020, when smart money accumulated assets that subsequently rallied 10x to 50x as market conditions improved. The strategic question for investors becomes whether you're trading technicals or investing in fundamentals. If you're a trader focused on the next 3 months, HBAR looks dangerous and probably should be avoided until clear signs of trend reversal emerge above 0.10 with sustained volume. If you're an investor focused on the next 3 years and believe enterprise blockchain adoption is inevitable, and Hedera has positioned itself as infrastructure for that transition, current prices around 0.09 represent an extraordinary accumulation opportunity. The divergence between price and adoption has rarely been wider. Networks processing $10 billion in real settlements with governance from Google, IBM, and Boeing don't typically trade at $3.8 billion market caps for long once market conditions normalize. The path forward requires patience and realistic expectations. Short-term volatility will continue. Price could easily drop to 0.08 or lower before finding a sustainable bottom. Range-bound trading between 0.08 and 0.12 is the most likely scenario through spring 2026, with occasional spikes in either direction based on broader market sentiment. The key levels to watch include support at 0.087 to 0.09, which needs to hold to prevent further breakdown, resistance at 0.10, which represents the 20-day moving average and psychological barrier that bulls need to reclaim, and the critical 0.115 level, which would signal trend reversal if broken with conviction. Above that, 0.13 and 0.15 become targets based on previous consolidation zones. For those building positions, dollar cost averaging over weeks or months makes more sense than lump sum buying, trying to perfectly time the bottom. Set a total allocation you're comfortable with, divide it into 10 or 20 tranches, and systematically buy regardless of short-term price movement. Stop losses below 0.08 protect against catastrophic breakdown scenarios while allowing room for normal volatility. Time horizon matters critically here. If you need this capital in 6 to 12 months, HBAR is inappropriate given current market conditions. If you can lock this capital away for 2 to 5 years and survive watching it potentially drop another 30% before recovery begins, the risk-reward becomes asymmetric. The institutional infrastructure is being built right now while retail investors are demoralized and prices depressed. That's always been how generational wealth is created in markets. You buy assets that are fundamentally sound but temporarily out of favor, then you wait for recognition to catch up to reality. Hedera has moved beyond proof of concept phase into production deployments with named institutions processing billions in real value. The governing council includes some of the most respected corporations in the world. The technology solves real problems that prevent enterprise adoption of traditional blockchain. Energy efficiency and carbon neutrality position it perfectly for ESG-focused institutional mandates. The integration with AI infrastructure and CBDC development puts it at the intersection of two massive secular trends that will define the next decade of technology. None of this guarantees price appreciation in 2026 or even 2027. Markets can stay irrational longer than investors can stay solvent, and macro conditions could remain challenging for extended periods. But the fundamental thesis that distributed ledger technology becomes core infrastructure for the global financial system appears increasingly validated with each passing quarter. The question was never whether this transition would happen. The question was which networks would power it and capture value from that transition. Based on developments through early 2026, Hedera has positioned itself as convincingly as any network to be that infrastructure layer. The current market is separating projects that have real utility from those that were purely speculation and marketing. Networks with actual enterprise adoption and production deployments are showing resilience in fundamentals, even as prices decline with broader markets. Networks that were hype-driven with no real usage are disappearing entirely. This washout period, painful as it is for holders, creates clarity about what actually matters. And what matters is whether your network processes real transactions for real businesses solving real problems. Hedera checks all those boxes in ways that 95% of crypto projects cannot claim. For investors trying to navigate 2026, the recommendation is straightforward but difficult to execute emotionally. Ignore short-term price action and focus on accumulation of quality assets at depressed valuations. Hedera at $0.09 with $10 billion in enterprise settlements and governance from Fortune 500 companies represents far better risk-reward than chasing whatever pumps 20% on a given day. Build positions slowly with capital you don't need for years. Set realistic expectations that recovery could take 12 to 24 months. Monitor key metrics like network transaction volume, number of enterprise deployments moving to production, ETF inflows, and developer activity rather than obsessing over daily price movements. The institutions aren't coming to Hedera. They're already there. They're already building. They're already moving real value through the system. The infrastructure is live and operational. What's missing is market recognition and favorable macro conditions that allow price to catch up to fundamentals. Those conditions will eventually normalize. Recessions end, crypto winters thaw, risk appetite returns. When that happens, the assets with real adoption and institutional backing will lead the recovery while zombie projects that survived on hype alone get left behind. Hedera has done the unglamorous work of building actual infrastructure while everyone else was focused on narrative and marketing. That work is about to pay off for those patient enough to hold through the pain. This analysis is for informational purposes only and should not be considered financial advice. Cryptocurrency markets are highly volatile and speculative. Always conduct your own research and understand your risk tolerance before making investment decisions.